Hello, this is Abhinav and I welcome you. In this video, I am discussing about the India taxation of private trust structures, right? So it's an overview video that I've made on what is the Indian tax provisions on private trusts. Okay, so first of all, trusts, as regards trust, they are not included in the definition of person under the Income Tax Act. So the Income Tax Act says person includes individual, company, partnership act, association of persons, but it doesn't include trust. So trust is basically an arrangement. The Income Tax Act doesn't, has a scheme for taxation of trust specifically. So the Indian Income Tax Act basically focuses on taxation of the individual persons, the individual beneficiaries, and not the trust. So it's basically, what is trust? Trust is like an arrangement or an understanding between basically three parties. One is the settler, the person who settles the trust, settles his assets into the trust. The trustee who then takes the onus of managing the assets on trust or settled by the settler for the beneficiaries. And the third are the beneficiaries, who are the ultimate kind of beneficiaries of those assets. So there are three parties involved: settler, who settles the assets; trustee, who maintains the assets under the trust; and the beneficiaries. So it's basically an arrangement between the three parties. Now, private trusts in India are governed by the Indian Trusts Act, I think 1882. It's an old act. It's governed by that act. There is no regulator for trusts in India, right? Like in other countries, there the trust structures are regulated. India doesn't regulate trust structures, but it is governed by the provisions of the Indian Trust Act. Okay. Now, Indian FEMA law, Foreign Exchange Management Act, also applies. There are certain considerations that apply for private trusts, especially when any of the assets or the beneficiaries are like non-resident. The settler is a resident, assets are non-resident. So, a lot of permutation combination. It's a very, very detailed, very complex topic. I've made a separate video on that, so you can check that. Now, private trust taxation is governed under Section 160 to 164 of Income Tax Act. Now, this is highly complicated kind of a provision. If you go and read the provisions of this 160 to 164, you'll be shocked as to why this kind of provisions are made. Now, these provisions have been inserted in the Act because in earlier times when India had very high estate tax and income tax, people were using these trust structures to basically avoid tax, right? They were creating trusts to transfer the incomes to the trust so that they are not assessed in their own hands. And that's why these provisions were inserted as a kind of anti-emergence mechanism. So the provisions looks very complicated. And uh, and though the trusts get taxed in the hands of beneficiaries, I'll come to how the taxation is done. But there is a practical challenge that is there in terms of the tax compliance and tax administration of private trusts in India, right? Now, how the trust is taxed? So, trustee, the people who have been given the assets to be managed, they are taxed as a representative assessee, right? So, they have their own separate personal assessment, right? But for the assets of the trust, they are taxed as a representative assessee, which is basically a separate assessment, and they are liable to pay the tax on behalf of the beneficiaries. Ultimate tax liability is there on the beneficiaries only, as per their respective shares under the trust. Trustee does separate tax computations for each beneficiary, and the tax is summed up and paid by the trustee, and the trustee is given the power to recover this tax from the beneficiaries. So basically, how the Indian Income Tax Act has been structured is that the tax liability falls on the beneficiaries only, right? Only the thing is that the trustee, as an administrative convenience, the trustees basically are liable to discharge the beneficiary's tax obligation to the Indian Income Tax Department, right? So what they do is that with respect to the income of the trust, they have to create like a separate computation. If there are four beneficiaries, there will be four tax computations that they have to do for each beneficiary, and calculate the tax which is payable for each beneficiary, and sum up the tax and pay to the government. And the trustee can then recover this tax from the beneficiaries or from by way of debit to the trust fund, whichever way, right? Okay. Now, discretionary trust. Now, in case of discretionary, so there are two cases, two trusts, which are, one is a specific trust where the shares of the beneficiaries are known, right, as part of the trust deed. Second is a discretionary trust. So the where the shares are specific, as I said, the separate tax computations for each beneficiary as to how much each beneficiary has to pay. That computation is done, and accordingly, the trustee is required to discharge the tax for the beneficiary. But in case of discretionary trust, where the shares of the trustees, the beneficiaries are not known, no there's no clearly laid down shares of the beneficiaries, then how will you do the tax computation? In that case, the income of the trust is taxed flat at a MMR, maximum marginal rate, and there is no basic exemption limit. So the maximum marginal rate is 42% something, so 43% in India right now, so that the income of the trust will be taxed flat at that rate. So that is like another anti-avoidance measure, that if there is a discretionary trust, then the income of the trust, to discourage such kind of discretionary trusts, the government has said that they will be taxed at MMR. Now, in case the trust earns business income, right? If there is a business income, that the income from the trust, then regardless of the type of the trust, whether it's a specific or discretionary, it will be taxed at MMR, right? So that is again a kind of a anti-avoidance provision, whereby basically a trust is not supposed to kind of carry a business. A person carries a business in his own name or by way of a company structure. So if such a business is done by way of a trust, then that business income will be taxed at MMR, maximum marginal rate. Then, when in case of trust structures, it is also important with respect to the taxation to check the application of the specific anti-avoidance provisions under section 61 to 63. Now, what are 61 to 63 provisions? Which is basically revocable transfer. That means any, then first provision is basically that if you transfer the income without transfer of asset, it will be the income will be taxed in the hands of the transferor. Second, it says revocable transfer. That means any transfer you do in the trust where there is a condition in the trust deed that the assets will form back, maybe some conditionality or something is there, that they can come back again to the transferor, then this respective, these provisions will get activated and the income will be taxable in the hands of the settler, right? If only and only if it's a irrevocable transfer where the assets cannot come back to the settler, in any case will the above taxation work. But if there is any condition which says that the assets, the can be kind of revoked, the transfer can be revoked, then it can be attracting the anti-avoidance provisions in the section 62. Then beneficiary being spouse, minor child, son's wife, in such cases there can be a clubbing back in the hands of the settler or the transferor, who has settled the assets under the trust. So when you design or structure the trust arrangement, then these specific anti-avoidance provisions of section 61 to 63 also need to be taken care of. Then there are practical issues with respect to TDS. So what basically happens is that the trustee, the trust does the invests in certain assets, and certain TDS is also getting deducted in the hands of the trust, right? But the net payer of the tax is the beneficiary. So how will the beneficiary get the credit of the TDS that has been deducted on the income of the trust? So this is a practical challenge, and I'm not sure how it is addressed in the kind of tax, through tax compliance or in the tax administration. But this is a practical challenge of the various, getting the credit of the TDS on the various incomes. Then there are disclosure requirements in the income tax return for the Indian resident trustee beneficiary of a foreign trust. So if you have if you're an Indian resident, ROR, resident and ordinary resident, who has any interest, like a beneficiary or in the capacity of a trustee in a foreign trust, in a trust which is outside India, then there is a requirement to disclose it in schedule FA every year in the tax return, as part of the tax return. And if you don't disclose, then there are significant penalties under the Indian black money law. So I will be making a separate video on the black money law. So there I'll be discussing in more detail the provisions of the black money law, right? Then foreign trust. So what happens if the trust is situated outside India and the beneficiaries are in India? So depending upon the residential status of the beneficiaries, the foreign trusts, any income from the foreign trust will also be taxable in India depending upon the residential status of the beneficiaries. So if it's like a resident beneficiary, resident ROR beneficiary, it's his world income will be taxable, which includes income with respect to his share in that foreign trust. So there is no kind of a differentiation in the income tax act with respect to Indian or foreign trusts, and this has been validated by the Indian courts in the 2021 Abu Dhabi Investment Authority case. So right, and I have also made a separate video on the specific uh, provisions with respect to specific considerations with respect to foreign trusts by Indian residents. So I'll take up that particular thing in more detail there. So that is it. This is like an overview video on the uh, India tax implications on private trust structures. I hope this was useful. If you have any queries, do share in the comment section. Thank you so much for watching this video.